Welcome, curious listener, to the deep dive. Today, we are embarking on a really interesting journey, taking a deep dive into a specific high probability buy pattern for the Nasdaq-100.
Mhm.
It's quite an intriguing strategy, often called the don't miss 2-hour cross. And our insights today, they're pulled straight from the material titled Jello 100 to Gensign.
That's the one.
So our mission for you, our listener, who wants that quick but really thorough insight, is to peel back these technical layers. We're going to pull out the core nuggets, show you exactly what to look for, explain why it matters, and hopefully spark that aha moment in understanding how these markets work.
Absolutely. And just to be clear, this isn't about general market feelings or guessing the next big economic trend. No, our focus is super sharp here. We're looking at precise, repeatable patterns, things that traders, experienced ones, are actively hunting for, trying to capitalize on. The real value, I think, is getting these specific structural insights, understanding how a candle forms, how an average behaves, finding that order in the, well, seeming chaos.
Okay, right. Let's unpack this then. Before we jump into the pattern itself, what kind of market conditions are we actually talking about here? What was the recent backdrop that set the stage for this pattern?
Well, the source material paints a pretty clear picture. It was a robust market setting. Leading up, you had major indexes closing right at or really, really close to record highs.
Okay. Strong performance.
Yeah, and crucially, it wasn't just a few big stocks doing the lifting. Market breadth had improved quite a bit. Think of it like the whole team playing well, not just the star. That broad participation, it signals a strong risk-on tone.
And risk on, just to clarify for everyone, implies...
It basically means investors are feeling confident,
Yep.
willing to put money into growth assets, And supporting this, you saw volatility bleeding lower, like the market's pulse just steadying out, less fear. And the dollar softened too, which usually helps risk assets. Specifically for the Nasdaq-100, the NDX, it finished strong near the top of its range, making fresh highs during the day. So all these pieces, the highs, the breadth, the low vol, the dollar, they kind of came together to create this really supportive backdrop, almost like perfect soil for these bullish patterns to sprout.
Okay, perfect setup. So here's where it gets really interesting, I think. Let's talk about the don't miss 2-hour cross pattern itself. Structurally, what's actually happening, both on the daily chart and that shorter 2-hour time frame. And how do they link up? That alignment you mentioned.
Right. The alignment is key. That's where the confidence comes from. It's what the source calls multi-time frame alignment, like having two maps, right? A big overview and a street map, both saying go this way, that way. So daily perspective first. The material shows the market is above the pivot, that saw point, and it's got this rising rhythm. It's not just bouncing randomly. It's trending up, kind of redefining its upper trading range, its upper box.
So the big picture, the daily, is clearly bullish, setting the tone.
Precisely. Then you zoom in, go to the 2-hour chart, and here you see the finer mechanics confirming that big picture. Price and a short-term moving average, they've crossed back above a key swing or base moving average. That's your initial bullish cross.
Okay.
But, and this is crucial for the don't miss part, the pattern targets the first retest after that cross. Imagine the market takes a little step back, just to check that the floor is solid before moving higher. That first retest is the sweet spot, often circled on the charts in the source.
Okay, so it's not just the cross, it's that first confirmation bounce.
Exactly. That combination strong daily trend confirming a precise 2-hour retest. That's what gives it the high probability. It's like the market stars aligning for you.
That multi-time frame alignment, sounds absolutely critical. Not just seeing one signal, but seeing it backed up. Okay, so you've got the setup. Powerful. Now the rules. What are the specific step-by-step rules for actually getting in once you see this? Precision seems key here.
Totally. It's not about gut feel. It's a checklist, like you said. The source lays out several rules very meticulously. Let me try and break them down. First, after that bullish 2-hour cross happens, you're looking to buy the first retest. But importantly, the candle making that retest, it needs to close in the top half of its range.
Okay, so showing strength even on the pullback, buyers stepping in.
Exactly. Shows conviction. Then, if you're thinking about adding to the position, you look at anchored VWAP.
Anchored VWAP. Remind us quickly.
Right. It's volume-weighted average price, but anchored or started from a specific point, like the open or the last significant low. Think of it as the average price paid since that key moment. You'd add if that level is reclaimed, so price gets back above it, and you're seeing improving tape quality.
Improving tape quality. What does that really mean in practice? How would you see that?
Good question. It basically means you're seeing strong, consistent buying. not just little trades, but more aggressive bids, good volume, pushing price up with conviction, like a strong current, not a trickle.
Got it. Strong flow.
Mm-hmm. You also want to confirm the Bollinger Bandwidth, or BW, is turning up after being squeezed tight, like a spring uncoiling, signaling more volatility, a potential bigger move. And this needs rising turnover, just means more volume. And finally, there's a point about trap resolution, when it's about 2/3 resolved.
Whoa, trap resolution, reclaim convergence. That sounds pretty technical. Can you simplify the practical takeaway there?
Yeah, sure. So trap resolution is basically when traders betting against the move get squeezed. They bet wrong, price goes up, they have to buy back to cut losses, which actually pushes price higher.
Ah, adding fuel to the fire.
Exactly. And reclaiming convergence just means price is getting back above key short-term averages that bunched up. So when about 2/3 of those trapped shorts are out and price hits a key turning point or inflection point, you can scale in more. You don't always need to wait for perfect touch of support. These rules, they're designed to be precise, you know? Take the guesswork out.
Incredibly detailed. It really does sound like a flight checklist for a trade. Okay, so besides these rules, are there common scenarios or like tells that make this pattern even more reliable, especially if the daily trend is already up? And before you even think of clicking buy, what's on that real-time checklist you absolutely have to go through?
Yeah, the source does highlight several repeatable patterns that kind of act as extra confirmation, especially in an uptrend. The classic one is just cross retest, big wide range up candle, textbook.
Okay.
Another is if you see an NR7 that's the narrowest range in 7 days, or maybe an inside day cluster, price coils really tight, then breaks out along with that 2-hour cross. Spring-loaded action.
Right, pent-up energy.
Or sometimes you see price sweep above a prior high, then quickly reclaim VWAP. That often fleshes out the shorts before the real move. We also see gap ups that fill part way, then lift off again from a swing line. Or EMA ribbons compressing, then expanding, think shorter averages like 8, 12, 18, lifting above longer ones like 40, 60. And finally, just a momentum reset, like RSI getting back above 50, MACD histogram turning positive again.
Wow, okay, that's a whole suite of reinforcing signals. It's like the market waving multiple flags saying, look over here. But that pre-entry checklist, what are the absolute must-haves on there for our listener?
Right, this is your final sanity check. Non-negotiables. First, market breadth. Need to see it improving. That advanced decline ratio ideally above 1.8 or so, more stocks going up than down. And the leaders, QQQ, SOXX, mega caps, they need to be participating, showing strength.
Okay, broad support.
Second, VWAP. Price needs to be holding above the regular VWAP, and that anchored VWAP needs to be reclaimed. Third, momentum. RSI back above 50. MACD signal crossing up, shows renewed buying pressure. Fourth, check volatility and the dollar. You want volo, calm market. And the dollar index, DXY, should be spike. It can be a headwind. Fifth, always check the calendar for the next 24, 72 hours. Big reports. Earnings. Don't get sideswiped.
Good point.
And finally, number 6, the risk-reward check. Does it make sense? Stop goes below the retest low. Potential profit needs to be at least 1.5 times that risk. This whole checklist, it gives you critical validation, filters out the weaker setups.
Makes total sense. Build that confidence layer by layer. Okay, so rules checked, checklist greenlit, stars aligned. How do we actually execute getting in, managing it, and crucially getting out?
Right. Execution is everything. The source gives a solid template. For entry, it's just scaling in, maybe 50% of your size when price breaks the high of that retest candle after the cross.
Okay, initial entry.
Then add the other 50% on a small pullback that gets reclaimed. Maybe 0.3% to 0.8% below the recent high. It averages your entry price and manages risk.
And if it goes wrong, when you pull the plug.
The invalidation point.
Super important. Clear rules. If price closes back below that key swing or base moving average, or if you get 2 bars closing below VWAP, you're out. No questions asked, exit the trade.
Discipline.
Absolutely. For adding on later, only if price clears a prior high and then a 1% pullback holds strong, with that Bollinger Band width still expanding, don't chase, add to strength.
Makes sense. And exits. Taking profits.
Couple of ways. First, take some off the table, maybe 30%, 50%. When price hits a prior high plus a little extra, say 0.5% to 0.8%, lock in some gains. Second, if the trade runs well and hits about 1.2 times the 2-period ATR, that's average true range, a measure of volatility, then you start trailing your stop loss just below the low of the previous bar, minus a tick. Protects those open profits.
Letting winners run, but safely. Exactly. And finally, flatten the whole position, get completely out if you lose a key daily pivot level or if that MACD indicator turns negative again. Having these clear exit rules is just as vital as the entry for consistency.
Absolutely critical. Okay, but what about the opposite, the warning signs? When should we just step back and not buy, even if it looks kind of like the pattern? What are those red flag conditions?
Yeah, knowing when to keep your powder dry is huge. These red flags are your do not enter signs. The source highlights 4 main ones. First, a failed cross. The cross happens, but then immediately you get 2 red bars closing back under the swing MA and VWAP. The signal failed instantly. Abort mission.
Okay, clear failure, no ambiguity there.
None. Second, thin thrust. Price is poking at new highs, but the volume, the turnover, is weak. Like less than 70% of its recent average is pushing higher on fumes, basically.
Yeah.
Lacks conviction.
Not enough power behind the move.
Exactly. Third, bearish divergence building while the bandwidth recompresses. This is a big one. Price makes a new high, but your momentum indicators are making lower highs. That's divergence. And if the bands are tightened again, danger sign, like the engine sputtering.
Got it. Momentum fading despite price.
And fourth, center box chasing without touching an outer rail.
Center box chasing.
Okay.
What's a simple way to think about that?
Think of it as jumping in randomly in the middle of a price range, far from any clear support or resistance level. You're chasing price in no man's land without waiting for a proper test of a boundary. It's usually impulsive and very high risk because your stop-loss placement isn't clear. Just avoid it.
Okay, so avoid the failed signals, the weak moves, the fading momentum, and the random middle ground entries. Good guardrails. Now let's try to visualize this. If we were looking at a chart showing this pattern based on the notes in the source, what would that textbook entry and the moves after it actually look like?
Okay, let's picture it. On the 2-hour chart panel, maybe on the right side, you'd see that clear yellow or white line crossing up over another. That's the bullish MA cross. Then right after, you see price dip back to test that crossover area. That specific retest candle closing strong in its upper half, that's your textbook entry, often circled in examples.
The first touch and bounce.
Right. Then, maybe a little later, you see a small, perhaps wedge-shaped dip. Price pulls back slightly, then quickly reclaims VWAP. And importantly, you see volume pickup on that reclaim. That confirms the strength and signals a potential spot to add on.
And the daily chart on the left, what's that telling us?
The daily chart is your context, your confirmation. You're watching those daily closes. As long as they're staying above that key pivot point, your confidence stays high. It's that multi-time frame alignment playing out visually. The big picture supports the short-term action.
It all ties together.
It really does.
Yeah.
And it's so systematic, as the source notes, that you could potentially automate alerts for it. Imagine setting up a TradingView alert or a Pine script that just tells you, hey, the 2-hour cross, the retest, and the VWAP reclaim just happened. It really highlights how rule-based this can be.
Fascinating. So wrapping this up, what does this all mean for you, our listener? We've really gone deep into this don't miss 2-hour cross pattern for the Nasdaq-100, unpacking all its pieces.
Yeah, I think the key takeaway is understanding how these precise rule-based patterns work. Combining that with the right market context, that multi-time frame view, the checklists, the strict entry and exit rules, that's how you can potentially turn raw market data into something genuinely insightful and actionable. It's about finding structure and discipline.
It really shows that even in markets that seem chaotic, there are these underlying rhythms, these repeatable patterns. If you know what to look for, it makes you wonder, doesn't it? What other precise rhythms might be hidden there, just waiting for a careful eye and maybe some systematic thinking, perhaps even automation, to uncover. Something to think about. Thanks for joining us on this deep dive.